Hello class, we're working on chapter 17 in the investments chapter. Now we're to the area in intermediate accounting where there's a lot of things you haven't seen, and so a lot of this is new material or lots of things that are new. So one of the things we're going to do in this chapter is we're going to cut out some things that we don't need, and we're going to kind of focus on the very basics and the important stuff at first. For example, derivatives. Derivatives is a complex type of topic, and we're not going to do anything with derivatives. If you own options or stock futures or any kind of puts or calls or something like that, there's lots of technicalities on that. But let's deal with investments. So, investments. We're going to have debt securities, equity securities, and then a little bit more with equity securities, equity and consolidation methods. Okay, so accounting for investments in debt securities. Well, what's a debt security? Is like a bond, could be a, we're on the other side of the bond transaction now. We're the investor in the bond. We're investing money and we're lending it to a company, and that company becomes our creditor. We're the creditor and they're the borrower. So it could be U.S. government securities like a treasury bond, treasury notes. Could be municipal bonds issued by states or cities or counties, or even a school district, or could be a sewer system, a special district that they put in sewers or roads, and they do a bond issue. Could be corporate bonds, could be convertible debt, commercial paper. So all this would be debt securities. So on debt securities, there's three categories. We need to say, are they held to maturity? Now, so think about a bond. I'm going to always just say a bond, right? But it could be all these securities. The debt security held to maturity, two things have to happen. You have to have positive intent to hold it to maturity, and you have to have the ability to hold it to maturity. So if you buy a 10-year bond, do you plan to hold it the entire time and just earn that income all the way? Then that's important. Then it's held to maturity. If it's trading, now you don't really see this one. This one is not as common. Trading is if it's bought and held, and you're making buy and sell decisions based on price changes, short-term price changes, interest rates go up, or bonds, U.S. bonds in Japan are cheaper, so you buy in Japan and you sell in the United States, or you're trying to look at short-term price changes. Now, in this case, you're either an investment company or a broker-dealer type company, so we typically don't see trading securities. So this is you're buying and selling frequently, and it looks more like inventory. Buying bonds is like inventory you can sell to somebody else later on, or vice versa, or whatever. The third one is available for sale. If it's not in these first two categories, then we call it available for sale. So it's not held to maturity and it's not trading, so available for sale. So this is probably the largest category. People may not just hold the bond for 10 years. They might say, hey, it's available for sale, and that's the kind of that middle category. Now, here's what happens. If it's held to maturity, then we're going to have the valuation on our balance sheet as amortized cost. Now, we know how to do bond amortization. I've done a couple more here on this spreadsheet. Any unrealized holding gain or loss is not recognized. And so we recognize interest when it's earned, and then we recognize gains or losses from sale. Okay, you already know how to do that. We're not doing a lot of entries with that, but that's what you need to know. Held to maturity is an amortized cost, and there's no holding gains or losses. So it's not at fair value. It's close. Like bonds are pretty close to fair value unless the interest rates really changes dramatically. Remember, when interest rates go up, the price of the bond goes down, and vice versa. The interest rates go down, the price of the bonds go up. The next category, if it's trading securities, then it's going to be at fair value, and any unrecognized holding gain or loss is actually recognized in net income on the income statement. So that's a pretty big deal. That's why a lot of companies don't have trading securities for these debt securities. So then you also have interest when it's earned and gains or losses from sale, just like normal. Now, probably the big category is available for sale. It's at fair value, but it's recognized in other comprehensive income, or OCI. I guess all the cool accountants call it OCI. Other comprehensive income, and it's a separate part of stockholders' equity. Once again, interest when earned, gains and losses from the sale. All right, so we're going to start doing some little problems here. Let's do held to maturity. So we're going to have several things with held to maturity. So what about the amortization on bond investments? It's just like our amortization before. So I built some. You can copy mine. You can edit mine. Use Excel. The more comfortable you are with Excel, that would be helpful. You can use the effective interest method. That's kind of the preferred. But they say the straight line method can be used if there's similar results. Now, because there's probably not a big difference, and we'll show you how this works. There's probably not a big difference between the amortization with the effective interest or the straight line method, so you might have problems that deal with either one. So it's accounted for, remember, at amortized cost, not at fair value. So I just set up a little problem. Shoup Corp. purchased $400,000 of 8% bonds of Holiday Inc. January 1, 2021. The bonds mature in 5 years and pay semi-annual interest payments on July 1 and January 1. The bonds were sold to yield 9%. Make the journal entry to record the purchase, round to whole dollars, and use the present value function in Excel to do all this. So here I have, here's the formula. There's a little function called formula text that's super handy if you're trying to show people what you're trying to do in Excel. So here's our formula. We're taking the present value of the interest rate is 9% divided by 2. We're taking the rate, and then the number of periods is 10. The payment is $16,000. The future value is $400,000, and we're solving. We're getting $384,175. So the entry would be, remember, it's an asset to us. It's not debt. We're buying it from another company. We're buying it from the Treasury, U.S. Treasury, buying it from the state of Tennessee. We're buying it from a company. We might own bonds from Disney. So we debit debt investments and credit cash. Now, I don't know if you would actually do this if the account is just investments or investments in. You might name some things, but generally this is all long-term investments or just investments, right? So this is a long-term asset category, investments. So here is our bond amortization schedule. So I just set up, and I think you're fine on this. If you need help, let me know. I'm happy to help you. But I built it the right way. You can go back and check my work. Here is the carrying value. Since it's at 9%, then 9% divided by 2, it's $16,000 every period. And I just took the $384,000 times the 4.5% and made it absolute value. And then you can copy that down. And because it's a discount, that means the interest revenue is going to be greater than the interest payment, and we just simply subtract the 17 minus the 16, and we get $1288. And the carrying value of the bonds is at a discount, and it grows to $400,000. So that's, you know how to do the bond amortization schedule. I'm not going to spend a whole lot of time on that because I think you know how to do that. And you can check my work. Everything is built on formulas. You can check my work if you need to. So what's our entry to buy the bond? It's $384,175. So that's that first entry. What about the first interest payment? Well, we're going to debit cash of $16,000. That's how much cash we received. We'll debit debt investments at $1288. That is the bond discount that we're amortizing, and we're crediting interest revenue of $17,288. That's that entry right there. That's how much that interest revenue is. The second one would be the same journal entry, except technically we get paid on January 1st, but we recognize the interest receivable for $16,000, and then the debt investments for $1346, and then interest revenue for the year, for the 6 months at the end of the year, $17,346. So that's how you do it. And then the very next day, you actually receive cash and write off that interest receivable number. All right, so the interest is earned basically through December 31st, even though you're not paid until the next day, January 1. So let's look at our balance sheet. The balance sheet we would have at the end of the year, we would have interest receivable of $16,000. That's that number that we just calculated. And then we have, under long-term investments, we have debt investments held to maturity of $386,808. Now, how do we get that number? That number is on the amortization schedule. That is the number after the first two interest payments. So at the end of 1 year, end of 2 periods, it's $386,808, and that is what's on our balance sheet, is the amortized cost, not the fair value. We don't have to go and figure out what the fair value is. Now on the income statement, we're going to pick up the 2 interest payments plus the discount. So that is, it's going to be these 2 numbers, the $17,288 and the $17,346. If we add that up, apparently that's $34,634. Excel is wonderful. It'll do that for us. So interest revenue is $34,634, and there is the carrying value of the bond. So that's how it works on the held to maturity. Now, available for sale is a little bit different, so we're going to do a similar problem. It is fair value through other comprehensive income, and the unrealized holding gains or losses as is OCI as a separate component of stockholders' equity. Any discount or premium is still amortized, but it's always shown at fair value. So I just set up another little problem where it's $100,000. We'll make payments at 10%, so 10% times $100,000 divided by 2 is $5,000. 8% for 5 years, so 10 periods, and so we end up with $108,111. There's your present value of the bond, just like before. And so we're going to make an entry, debt investments and cash, $108,111. We'll do the bond amortization just like before. Here's how you do it: 4% times the 108. Remember, it's 8% annually. 4% is for the 6 months. And then we'll recognize interest revenue just like before. So we have cash of $5,000. We have debt investments of $676, interest revenue of $43.24. All right, because this is a premium reduces our interest. It is a 10% bond that is sold to yield 8%, so that is why our interest revenue is less than the cash payment. Same thing for the second period, and we get the cash on January 1st. So let's do this. Assume on December 31st, the fair value of the bonds is $105,000, and the carrying amount is $106,733. Now we already know it's $106,733. So, but we're having to do, because this is available for sale, this is the fair value. So it's at 105, even though it's on the amortization schedule at 106,333. We need to debit the unrealized holding gain or loss for equity, and then we have a fair value adjustment that's a credit for 1733. The difference between the 105 and the 106,733. Now, what is this unrealized holding gain or loss? Well, it's a nice little account, because what you can do is you can put that account as a debit or a credit. If it's a debit, it looks like a loss. If it's a credit, it looks like a gain. So we have a loss here from 106 down to 105. And this goes through equity, other comprehensive income in stockholders' equity. So that's the kind of journal entry you need to make for this. So that's one example. But let's look at example for a portfolio. This next one, let's say we have two little bonds here we own, and here we have the cost. It doesn't really matter the individual ones necessarily. We have a cost of $293, the fair value is $284, so we end up with a loss. So this is our loss that we need to make an entry for. So the entry is going to be for $95.37. Debit the unrealized holding gain or loss dash equity, because it goes through stockholders' equity. And this is going to be a fair value adjustment, $95.37. So that's how you do it for available for sale securities. Now all these are debt securities still. We got one more where you have trading securities. So this is fair value that shows up through the net income. So this is fair value shows up on the income statement rather than available for sale, which is fair value that shows up on your stockholders' equity. So unrealized holding gains and losses reported in net income, and holding gain or loss is the net change in fair value from one period to the other. And we're not showing the multi-period. You might see that on homework, but we're not showing that. So let's just look at the example. Let's say we're now a trading security. We have 340. It has a fair value of 350, so we have a gain. We have an unrealized holding gain of 10,000. Then we debit fair value adjustment and we credit unrealized holding gain or loss dash income, because this is $10,000 gain and it flows through the income statement. So our net income is going to be $10,000 higher before tax, right? This would be included in net income. All right, so let's switch over to equity securities. Equity securities is a fancy way to say stock, right? So stock securities, I guess technically it would be mutual funds or exchange traded funds that own shares of stock. So the cost is the price of the security plus any broker commission and fees. The percent of an investment is one thing that's important, because remember, stock is ownership of a company. So if you own 10% of the stock, you own 10% of the company. If you own 51%, then you control that company. So here are the three categories. Now, the way it works is we're going to say less than 20%. That is, we use the fair value method if it's available, if it's practical. If not, then you can't use it. If you own a privately held company, you own 20% of a privately held company, there may not be fair value for that stock. So any unrealized holding gain or loss is recognized in net income because it's fair value. And then other income is dividends declared and gains or losses from sale flow through income. If you have less than 20%, that's the fair value method. Now, 20 to 50%, you are deemed to have significant influence, and we'll talk about this in just a minute. You're going to use the equity method. So you're not going to have unrealized holding gains or losses, but you're going to pick up, now this is different, you're going to pick up your proportional share of the investee's net income. So if you own 30% of a company and they report net income of $100,000, you're going to pick up $30,000 as income because your company you owned made $100,000. So the fair value, you're less tied into fair value, but you're tied into how well that company is doing. We'll show you an example. And then this sounds complicated. For our purposes, it's very easy. Anything more than 50%, it's consolidated. That means it's rolled up into the parent company. There's no unrealized holding gain or loss, and there's no income effects. All right, so let's start working, then we'll do these first two. So let's say Warner Inc. has equity investment portfolio, and they believe in breakfast, looks like. So they have things like Pop-Tarts and Hungry Jack. So what they have is they have cost, and these are all stocks, and they have fair value. So they end up having a little bit of a loss, a $30,000 unrealized gain or loss. So what do we do? We'll show that in just a second. But first, let's say what happens when we receive dividends from Pop-Tarts. Pop-Tarts issued dividends of $4,200. So Warner would make the entry debit cash, credit dividend revenue for $4,200. That's their share of that. Well, what do we do about this $30,000 unrealized loss? We're going to debit unrealized holding gain or loss. I need to make it with unrealized holding gain or loss. 30,000. That's, since it's a debit, looks like a loss. And then fair value adjustment is a credit, 30,111. Okay, let's switch over to, let's look at the equity and consolidated methods for stocks. If you're an equity investor and you own 20% all the way up to 50%, then you have significant influence, and that's a phrase that the FASB has talked about, and so you have to use the equity method. Now the equity method is a little bit different. So we're going to record the investment at cost, and each period we're going to adjust, we're going to pick up the investor's proportionate share of earnings or losses, and we're going to pick up the dividends. We're no longer tied into the price of the stock because we own 20% of the company, or 27%, or 34%, or whatever it is. So an example is going to be very helpful here. So let's say we have an example for fair value and for equity method, and they're pretty simple. You just got to be careful about where you are. So let's say that Drew Corp purchased 55,000 shares, which is 25% of Max Corp at $20 per share. Now, what's the proper accounting for it? Well, the proper accounting would be the equity method. So this is the proper way to do it over here on the right, but we'll show you how the fair value works. So this, I guess on the left side, we're going to assume that it's not 25%. It's just the equity. It's not 25%, so it's the fair value method rather than the equity method. Okay. 55,000 shares. Debit equity investments, 1.1 million. Credit cash, 1.1 million. Both of them the same. Now, let's say Max Corp reported net income of 300,000, and Drew's share is 25%, or 75,000. Well, under fair value, there's no entry. But under the equity method, it says, look, you have significant influence in this company. You own 25% of this company, and you're going to pick up 75,000. So 300,000 times 25% is 75,000. You're going to debit your equity investments. Your equity investment goes up by 75,000, and your investment income goes up by 75,000. So that's the equity method. At the end of the year, Max Corp has a fair value of $23 per share. It was $20, and now it was $1,100,000. Now it's $1,265,000. So fair value, you'd have to debit fair value adjustment and credit unrealized holding gain or loss dash income for $165,000. On the equity method, there's no entry. All right, so that's how you do it. We got a couple more little examples here. What do we do if there's a cash dividend? Well, Drew received $20,000 of the $80,000 dividend, so they just debit cash and dividend revenue $20,000. Now, for equity investments, this is like Drew owns a significant portion of the Max Corp, and it's like Drew withdrew money from Max Corp, so they're going to debit cash $20,000, and they're going to reduce their equity investment by $20,000. That's the difference in the equity method. All right, a couple more. What if there's a net loss? Your share is 25% of the 120 or 30,000. No entry for fair value. But for equity method, you're going to debit the investment loss and credit the equity investments. Your equity investment goes down with a loss, and the amount is 30,000. All right, just a few more little things here. What if there's a fair value of 22? It goes down. Well, we adjust. It goes down to 1,210,000. It was 1,265,000. We have a loss of 55,000. So we'll debit the unrealized holding gain or loss should be dash income. You can't see where it has dash income. So I can make it a little bit smaller here. Unrealized holding gain or loss dash income, right? And then the fair value adjustment is $55,000. All right, almost finished here. What if you own 51% or 70% or 75%? Well, then you have purchased a company, essentially. You have one company, which is the parent, which has acquired another company, the subsidiary. So there's really no problems here in intermediate on this. This would be if you took an advanced accounting class where you have consolidations. So for example, you know, Yum Brands owns KFC, which is Kentucky Fried Chicken. They own Taco Bell. They own Pizza Hut. There's probably a few investors that still own Kentucky Fried Chicken directly, but majority of that company is owned by Yum Brands. Now they're separate, two separate legally different entities, and so at some point Yum Brands could sell KFC and let it be its own company. But right now they own a majority and they get to control whatever that company does. But there's probably some original investors in Kentucky that own shares of Kentucky Fried Chicken directly. All right, so you never see a Kentucky Fried Chicken financial statement. You only see Yum Brands, and it talks about different divisions or whatever. Now, derivatives is part of this chapter. It's in the appendix. It didn't used to be in intermediate accounting. Derivatives have become more important. It's in intermediate accounting book as in the appendix, and it is a complex topic. Lots of things going on there. That is a potential CPA exam question, but we're not going to do anything with the derivatives for our purposes. In this, the summer boot camp, you can learn about derivatives, when you have more time later on. All right, thanks, good luck, and keep going. You can do it.